This is November 16, 2015. This is Clueless 8, and this is Advanced Coaching Session, the group Advanced Coaching Session. We have several members of the Clueless 8 trading service, and I'm going to do a quick roll call. I have Savvy. Okay. I have Shawnee.
Yes.
Excellent. I have Tom. That's Fairway.
Me? Yep.
Okay. Excellent. I have Trina.
Hey, Clue.
Hi. Okay. And I have Paras.
Yes.
Thank you. I have Tats. Okay, Tats, you don't have a microphone, I'm assuming, right? No problem. Mark Bader, Amar?
Yes, here.
Okay, good. I have Always Learning.
Yeah, I'm here.
Hi, how are you?
Whoa.
Good. Good to hear your voice. All right. Let's see here. Okay, good. So we're going to kick off tonight's group coaching session, try to make it as constructive as possible, and try to keep it short and concise instead of dragging on too long. It's a Monday night. We all need our beauty sleep to be ready for to do battle tomorrow. Recording is on November 16, 2015. Group coaching session, Clueless 8. We just did the roll call. Full disclaimer, this is purely for educational purposes and not for any solicitation or advice. So let me kick off. Let's talk a little bit about, let's not talk. Let me just point out a couple of the most critical factors that dominate trading and investing. I do not want to sound like a professor. I just want to share what I go through every single day. And I believe you guys go through it if you're actively trading or even doing anything with the market in a much bigger way. First and foremost, it's a pure mental game. There's a term called PTSD. When you come back from a battle zone, you get these flashbacks. Now, what I'm talking about, I'm not wasting my time away from my family time at 8:30 when I could be spending some precious time with my wife and my kid. Instead, I'm doing this. So please, let's focus. So the point is, what I'm talking about, don't take it lightly. Take it seriously, because if you try to apply, and I'm talking about myself too, by the way, okay? If you try to apply even 1/4 or 1/5 of what I try to do every single day in the stock markets, then I believe that you will negate a significant amount of bad habits and change your systematic pattern of losses and make some substantial gains on days like today and hopefully the following couple of days, and not always blame everything else around you for all the miseries that you all go through. And that applies to me too. But I'm maybe one step forward because I actively deny myself the luxury of blaming everything else around. The only person you really have to blame because of your inaction and your inactivity and your inertia on powerful, powerful days like today, which gave you multiple chances earlier in the day, which I walked through people through my hard work. And I will say my hard work. And as far as I know, I actually like all of you. Well, some of you I like more than others. So the bottom line is, think what I'm saying. You had multiple chances of systematically positioning yourself to look at the end of the day with some dynamite returns, powerful returns on selected positions. Even if you came into today with 99% cash, in which case you would have a phenomenal day. I came in with some positions because I started scaling in on Friday. I added to the same positions, added a few new ones, small ones, but basically stayed position in my stayed within the same positions that I had from Friday. And it turned out to be a solid day. I didn't tinker around much. I scaled down, took some profits off the table, and things that I was upside down on, like JD.com, I came out with a profit. Now, saying all that, I don't know what to say. Sometimes when you do this business, honestly, and let me be very straightforward, I really don't care about any of you and what you do with your trading thing. And that's the best thing you'll ever hear from me. Because if I coddle all of you and say, oh, I'm really sorry this happened to you, and this is, oh, it's such a bad market, it's so terrible that we are bleeding red, on some of our positions on Friday, and I'm sorry that you didn't take the hedges on the UVXY, which delivered some significant returns on Thursday and Friday, specifically Friday. I'm really sorry you did that. It's really not your fault. I'm sorry. I don't spoil my kid like that. I'm not going to spoil you guys like that, ladies and gentlemen. Because that is the worst thing I can do for you. And if I tell you I really do care about what's happening to you, no, I don't. Because the reality is, you don't care what's happening to me. You don't care if I'm down 5 figures on my portfolio on a certain day. The only thing you all care about, this is called tough love, okay? This is boot camp. The only thing you all care about is, wow, he got me into this and now I'm up 300%. Man, you're a genius. You're great. I am not great. I'm human. Only God will tell me if I'm great. So guys, ladies and gentlemen, what I'm getting at is wake up. I'm serious. Wake up. Because there are ample opportunities that I'm showing. I'm showing you unbelievable middle of the day multiple Periscope broadcasts on and from Friday, showing you basing patterns, showing you these massive oversold conditions that are exactly the same parameters as where we were on August here and here, showing you big fat arrows on these things on the market. And yet many of you, and remember, this is not pointed at anyone, I'm just saying it because I have to say it, showing you multiple scenario where you don't even have to be a technician. You look at this and you say, wow, with this oversold, we're going to have a serious bounce. And then I'm walking to you all of you through multiple tranches of what these lines mean and where they're going to go, through Fibonacci retracements, through charts like this, through my algo pivot charts. For God's sakes, pull them up right now on the Twitter feed. And yet, many of you sit there frozen. For what? I show you, it's like paying penny stocks, right? Things at 8 cents, which close at 24 cents. And for all I know, they're going to go to 50 cents or $1. And you can take a position. I'm sure some of you did, no question about it. But what I'm getting at, I do this business. I know how traders think. I used to know how my clients thought in the old days. And I can see through these chat rooms and these the digital platforms that we use what you guys are going through. Almost see it. I know when you guys get all frothy and bubbly and stuff. On days like last Tuesday, when I did almost nothing as new positions, and I warned everyone, sell when you can, not when you have to. And then what happens on Wednesday? So, how about this? Stop being a child. Because adults are the worst possible children that anyone can think of. Believe me, we have no right to discipline our children when we don't know how to behave in an environment that we are operating in. In this particular case, we're talking about the US financial markets. We're behaving like children. I'm serious. Look at yourself in the mirror. Look what you could have done today. And what did you do? You acted like a scared child because of what happened last week. The past is no indication of your future. I put something up on the Twitter feed. Read it, print it, and put it on your walls. And I'm sure a lot of you, all of you, are very successful in what you do. But success in the financial trading markets is a totally different story. This is the most difficult mental process you will ever go through. And I don't give a hoot how successful you are in your own business. Trading and investing is real deal. It teaches you who you are and what you're made of. And I am not the BTFMD, buy the you-know-what dip type of trader. You have to be selective, you have to play it, and you have to go with it. You think the machines have emotions, like I say? You think they look around and say, oh, I'm really hurting right now. You know, I'm not going to buy. Oh, I'll wait for it. No, they just do it because they're going with price momentum. Yes, when things started to really fall apart, we sliced our fingers a little bit on trying to catch some of the falling knives on Friday. Yes, I had some hedges which worked out damn good. And some of you did too. But the point is, they weren't big enough to cushion the blow when you left that machine and your computer on Friday afternoon, after 4. It hurt. So what? It hurt. What happened today? And you know why today hurt more for many of you? And I wish the whole group was in here right now to listen to this. You know what hurt the most? Is the fact that you didn't make up a good portion or a solid portion of what you got hurt on last week. That hurts more. I don't need to know the answer. I know it. Okay? So it's laughable what we do. And I said we. Maybe I do it a little bit less than what you guys do. But honestly, I don't know what to say. Keep on doing the same old idiotic stuff off the lows. And this is an intermediate low in the market. And I'll show you tonight on a technical basis, once I get done with this behavioral game theory stuff, that this is an intermediate tradable bottom, as I keep on saying, in the market. I don't know whether you can trade it for 2 days or 3 days or 5 days or till the end of December. But if this sticks, there is absolutely nothing that can stop the market to going back to 2130 again. My videocasts have openly clearly shown what the downside can be, what the support levels can be, where we can go, and of course, the far-flung outliers, which are the low probability things of a massive, unprecedented crash that brings us down to where we were back in August and September. That's a low probability trade. Ladies and gentlemen, the financial complex that we operate in is not a fair place. This is not where, oh, I think it's really bad. The company did something so bad. Who cares? The market just right when you think the company's really bad, whatever the earnings, because you're trying to be a top-notch analyst in your head, it turns around and goes 10 times higher. Or when you think the earnings are good, oh, they beat revenues, they had strong earnings. So what? And it falls down. There's way too many things that happen in the middle. So what I'm getting at, ladies and gentlemen, for God's sakes, when you get the opportunities, don't blow it. Don't wait. Don't keep on saying, oh, next time. What is your next time? The market gives you multiple chances to buy down here, and in this particular case, on a short-term basis, to buy down here, which is completely symmetrical. And we're going to go over that in a few minutes. Okay? Completely symmetrical. and you say, oh no, I'm going to wait for something better. Yeah, what something better? And I'm not even saying go out there and put $20,000, $30,000, into on crazy stuff, into options, stuff like that. I'm talking about smaller amounts of money scattered in some selective positions, which can be up 30, 40%, and you feel great when you leave the day. I said something today which all of you should write down and put on your wall or whatever you write on, okay? Back of a napkin, I don't know, your socks, on the back of your hand. Your euphoria. And believe me when I tell you what I'm saying, because I live by these mottos. And it's not easy, believe me, okay? Nothing in life which is great is easy. That excitement and joy and euphoria should be when we get prices 6, 7, 8% lower for no reason other than the fact that we are having a coordinated global sell-off because of oil and because of these bastard terrorists who bombed Paris. Look, I've said it in this morning session. I won't go into it now, but look, I'm a survivor of 9/11. Okay? I'm very hardcore in my beliefs. I believe that every person is a good person overall, but I think there are a lot of rotten eggs for whatever reasons. Okay? So I'm not going to get into that. But what I'm getting at is that when you have global turmoil, you are going to see markets go higher, because markets, especially when you hit a major economy like France, what are they going to do? Just fall apart? Like after 9/11, they said, oh, we'll never come up. In 1 week, we were up huge. We were closed for 1 week. You couldn't buy enough. It was the best time to buy. So the point is, if you think that global turmoil is going to take us down, then what you're doing is you are in submission, kneeling down like those people who were executed by those bastards. Excuse my French, I'm sorry. But we're grown-ups here, right? We can handle this language, right? So the bottom line is you are submitting to the powers of evil by saying, oh, I'm going to sell all my Netflix and my Teslas and everything and just go away because this is really, really bad. I don't know what to tell you. If you guys are not grown up enough to understand the adult behavior of markets will never submit to terrorism. And I don't care what you think. Over the short term, they will go higher to send a message that we shall not succumb, that we shall prevail. Don't you guys get it? And that's exactly what happened today. And on technical terms, it hit some certain levels. I was watching this morning. I was watching last night. I posted the charts out there on the E-minis. We went to 1998 on the E-minis, hit a major inflection level, opened the market up, fuddled around, just made up a word, fuddled around, threw people off. People try to day trade back and forth, fine, you can do that. Internals are saying, hey, we want to go higher for a bit. No one wants to listen. Well, most people don't. There were 5 people in the chat room today. No offense, man. I'm sure people were busy and they were taking the trades and doing well. I'm just saying in general. What happens when the room is bubbling? There's 20 or 30. They're coming from nowhere just to say it. Today should have been the day when everyone should have been in there looking for opportunities. No, but they went and hid behind this big rock because ISIS is coming to get us. Jesus. I don't know what to say, okay? So look into yourself first. Let's go into the technicals here. At this point in time, I have to make some projections because my job is forecasting, right? I want to make something very clear to these precious few who are in here today listening to this webinar. Of course, I'm going to upload it so people can hear it. Look, my responsibility in this subscription service is none. That's N-O-N-E. I have no responsibility of whether you do well or not do well, whether you're happy or not happy. That's your job. My responsibility in being Clueless 8 is to provide and share my experience, my technicals, my expertise in discerning patterns, breaking it down, analyzing it, and passing on the message of the markets to you a little bit maybe ahead. So that becomes a predictive analysis, right? That's why the predictive game theory aspect comes in. Through my different charts, how I draw on them, I see a picture. I see what might happen. That might happen is known in proper English and mathematical terms, a probability. You want complete certainty, I can give you that because there is nothing called complete certainty. We're not even certain if we're going to wake up tomorrow morning. It's a fact, right? Exactly. So the point is that my job is to make sure, I want to make this very clear, is not to be your broker. Well, certainly not. But not even to really be responsible for whether or not you're up, down, sideways. My job is to show you some very serious roadmaps, some powerful precision guided GPS maps via charts, my comments, my constant interaction during the day, which at some point I will reduce. I'll probably pop in maybe 3 or 4 times during the day. So the point is, so that you benefit from what I'm trying to show. But if you don't take the full responsibility on yourself to understanding 50% of the message, what these charts are showing you, and going forward, which all of you are actually, that's the reason why you're in this group coaching session, then I must tell you, you have failed in what you're doing. And I have failed in convincing you that you should be doing that. Okay? So I just want to make it very, very clear, because sometimes it gets to me, because babysitting and hand holding and pushing the baby stroller is all fine and good. But at one point, it's like, get out of here, because there's a lot of people out there just don't want to do the work. They don't want to understand the chart. They don't, whatever the case may be. So let's take a good look at this chart. This one chart tells it all, by the way, just so you know that, okay? And it's so simple to read. What is hard is that along the way, on its way to where it's going to go, it's going to do all kinds of little twists and turns. Now, if you can handle the twists and turns and get thrown out of the trade like we all do at certain times, then that's a different story. Some people get skittish. Like I said, when you come back from a battle zone, like we went through since let's say the 9th, like earlier on this month, first week, from here, then you get scarred. So you get PTSD in the middle of the trading day, right? You get flashes. Oh my God, what happens if oil collapses again? Even though oil hit a major tradable low, we're going to look at that chart in a second, which I've showed many times, and it's going to bounce to a certain level. I'm not saying it's going to go back to 50. I'm simply saying that we're good for $2, $3. That's good enough for now. So don't get PTSD just because you came off a major drop in the market. And that was a major drop in the market, no question about it. How much did we lose? Like 600-700 points fast. So don't get PTSD in the middle of the day, okay? Stop being so shell-shocked. It's not the end of the world. Take positions, small ones. I don't care. At least you're in there. So if you go backwards, you're not like going crazy. Okay. So here we have a large rising wedge shown through these 2 blue lines here. We have major bottoms here. Major. This is chop. I don't know how the heck we traded this move here. I know we were trading bits and pieces of it. Then you have the Fed fake out. This faked me out too. Now that in hindsight, it looks, this is what's known as a naked bar or an inverted candle. I mean, what do you call spinning top and a inverted hammer. See the hammer, the handle of the hammer and the head of the hammer? Inverted hammer and then full scale crash. Little fake out here to get people in and then full scale crash. Creates a beautiful double bottom. Okay, so I keep on repeating it, but repetition is the key to success. Believe me when I tell you, in trading. So then you have this big move up, literally a big move up. Let me show you something simple. and I'm sure all of you already know that, is when the bottoms occur and you get a major reversal hammer. I have repeatedly said that the biggest monies are made over the first 24 to 48 hours. Not totally true, but somewhat true. So you get this massive hammer reversal, big green candles. Then you get one bad day. This was probably a 100-point day, this red line. Let me get this out. I'll just show it via, I'll just show it with this spotlight. Okay, so here, so you get this, a couple of, actually if I do the red, it covers the whole thing. Sorry, hold on. Do the pointers. So you get these big candles. That's big money. You bought it down here. You're talking about the SPY calls maybe up 100% here. And then you think, oh my God, it's all over again. It's going down because you get this reversal candle that day and all kinds of stuff. Next day market goes up, then it falls down again. And you're like, wow, I can't take this anymore. I'm going to just wait out. Good. You waited out. Sure. And then what happened? The market went up 300 points. Just like that. Was it 300 points? Probably, yeah. Right there. Look at the size of these candles. Bang. What does the market do? It creates pattern symmetry. It gets exactly back to where it fell from. I don't need to tell you how many times I've showed you this. Then it creates a consolidation channel. And you're like, oh my God, we're going down again. I'm staying out. I'll wait for I'll wait for another time. Yeah, another time, right. Market just takes off. By the time you get in, maybe up here, market comes down. You're like, man, I really hate this. Every time I go in, as if somebody's watching me. Let me remind you something. You're not big enough for somebody to watch you. When Bill Ackman moves $500 million worth of stock, somebody's watching him. Nobody's watching you or me. We're little flies in the middle of Congo, okay? That you get swatted. Go see those horrible movies about child soldiers, okay? Diamond something, right? Remember that? So nobody's watching you. You're nothing in the scheme of the market. So don't think you're that special. I keep on hearing that all the time. Oh, I buy and then the market goes down. Is this somebody's really watching me? I say, Jesus Christ. How many times am I going to hear that? Yeah, you know who's watching you? That little voice in your head is watching you, which makes you do all the stupid things in your life. That's who's watching you. So the point is, this is what happened. Big surges. I don't like big surges like this. By the time the market was up here, I wasn't even playing that much. I was doing the indices. I wasn't chasing the price lines. I wasn't chasing the Netflixes. Yes, I was maybe trading intraday a little bit. I was warning everybody, remind everyone in clear words, don't take large oversized position. We're significantly overbought. We are staying overbought, but a reset is coming. What was the other thing that I mentioned very clearly? That around the 15th of the month, give or take a couple of plus minus 2 days, we're going to get ugly because that's exactly what happens all the time. Aside from August 24th, which was past the 15th of the month. This market bottomed August 24th, but before that, it started falling around the middle of the month. So guess what? This middle of the month was the same. For different reasons, of course. Same reasons, actually, oil. Okay, so we're back in this channel here. This was the consolidation channel we technically wanted to hold. So we're back in the channel. So what's the next stop? Next stop is 2080, 2075, 2080, S&P 500. First stop is around 2065. Where did we close at? 2053. So that's where we're heading. Now, if we slip a little bit tomorrow, let's say, and we certainly can, we can slip, we can do this, we can even do this. We can come down to 2016 again. That's about 36, 37 S&P points. That's roughly 260 points. Let's say we gave back everything we got back today. Does it change the overall pattern? The answer is no. It creates another the what we call a dragon bullish or a W. Think, for God's sakes, like a technical robot. Stop thinking like a typical pathetic human like we all are. Seriously. Now, does that mean that you have to hold on and suffer the pain of going down another 230 points? No. We'll be proactive. We'll take some hedges on, and we're not going to necessarily hold on to any large positions if we are going to do this type of pullback. Now, the market doesn't always raise a red flag and say, hey, let's go down 230 points. It does it in stages, right? We know that. Just the way it did it in stages today on the upside. Multiple times. It didn't even, what, the market was up how much? Like a little bit. It was down. Then it turned. So this could happen. This could happen. These bastards might attack somewhere else. God forbid, no, but they might. So the market goes down and said, God, what really becomes dangerous from a technical standpoint is if we break this downtrend line that we fought so hard to break here. So that downtrend line retest at around 2000 to 2008, which we, by the way, did. We were down here pre-market. We actually, I believe, we almost tested this. Almost. So if we basically break below the downtrend line, like they say in Spanish Harlem, no bueno. Okay? That's no good. Because at that point, you're looking at 1950. Whoa! 1950, the end of the world. Nothing really changes. Honestly, the market doesn't even change till we break 1860. Just letting you know. At that point, we're in a full-fledged multi-month bear market, in my opinion. Or at least a month or two. Because there'll be way too much technical damage if we go all the way down here again. Because third time, in my opinion, you hit something third time, it gets weaker. It breaks. So 1860 will break, then we're talking about a different story. I'm clear on that. So that's an outlier. It's a possibility. It's an outlier. So what I'm getting at is this other thing that I keep on talking about. Stop thinking the market in very simple binary terms. Oh, if this doesn't happen, that'll happen. No. How about this? If this doesn't happen, there are 3 different things that can happen. That's called game theory. Multiple outcomes from a single action. Okay? When people plan wars, like the generals, they use game theory big time. So if we attack this corner, then what happens if this comes and that comes? There's all these what if scenarios. So as traders, try to train your brain not to think like 3-year-old babies, or 3-year-old babies actually probably are smarter, like kindergarten kids. All right? That, oh, if this doesn't happen, that's going to happen. It's not a binary market, guys. It's not a linear market. Along the way to where it wants to go to, it will do its thing. It can do this. It can just go up here, which would be nice. Or it can pull back here, give you another chance actually for most of you to actually buy, because most of you didn't buy as far as I know. Because you're all waiting around for, waiting for Godot, right? Godot. So it's like the Pied Piper never came. Market wants to go to 2070, 2080. This is a very powerful signal. Yes, it might kind of meander around here before it goes, but at one point we will go up here. And that means we go up here. So bottom line is that, let me get these lines out. And I'm going to stop here for a quick second because I want to make sure everyone's on the same page with me, because me just rambling on is a waste of my time and certainly a waste of yours. So at this point, this is very powerful. This is a serious bullish engulfing. Very similar. Look at the pattern similarity between these things here. Look at this. Do I need to point this out to anyone? Look at this. Look at this. This went like this, and this will go like this. Will it go in a form of 1, 2, 3, 4 steady days up, which brings us towards the latter part of the week? I don't know. But given what I'm seeing here in pattern symmetry, it might very well do that. And by the way, this did that off overbought conditions right here. See that? This is doing that off oversold conditions, except it's a massive positive divergence. So I'm going to stop myself here and ask people, what do I exactly mean by saying that this is a massive positive divergence? This, by the way, I did cover on my video cast. So it's not a quiz. It's not a SAT test that my son just got done with. This is simply to make sure that you guys actually understand what the heck I'm talking about. So bear with me 1 second, like I try to get this thing out. When I say that what I saw in the internals is a massive positive divergence, I'm going to start off with Mark Bader. Mark, what do I exactly mean by saying that this was a massive positive divergence that is just fantastically bullish, at least for now? I mean, take a shot. Like I said, we're not putting anyone down. Okay, let's make good use of the time, because I don't want to sit here, honestly speaking, till 10:30 at night. You know, but if you don't understand it, say, hey, Frank, I don't understand it, and I explain it after I ask other people. Where do you see the positive divergence? If you're watching my video cast, then I have already explained this, and I've explained this many times. So I'm not putting you on the spot. So go ahead, sir.
Just because we're still all the way down, we're nowhere near the oversold yet on the statistic.
The stochastics is, no, you're getting to the right answer. What you're saying is the stochastics is all the way down here, which means it's deeply oversold. This is deep oversold. Okay. Right. Yeah, and go ahead. So what's the second part?
I don't know.
The second part is the price. The price is thousands of points higher, at least in Dow terms, or at least 200 points higher from here, correct?
Right.
But we got the same technical oversold conditions. In other words, this is a major positive divergence. There. You have to understand this is one of the biggest concepts in technical analysis. So let me try to explain this again to everyone. Here, we are all the way here, and we were all the way down here. The difference is 200 points, which is roughly about 1,600 Dow points. We are roughly, let's say, 1,500 Dow points higher than where we were on September 29th. Is that clear with everyone?
Yes.
Okay.
Yes.
We are 1,500 points higher. Yet the internals are equally oversold. That's known as a positive divergence. Did people understand that, or they didn't? In other words, the internal damage and the level of selling. Let me explain this in simple terms. Again, the level of panic and the panic selling that we endured just by a drop from here to here was severe enough to cause an oversold condition that was 1,500 points lower. Because this was, you understand what I'm saying?
Yes.
At this point, I believe we also gave back roughly. Yeah, at this point we also gave back roughly 1,500. What do you call the same length? It's if this is geometry, this is the same length as almost the same length as this drop, a little bit longer, right? So basically, when internals get that oversold, panic selling, what we call capitulation. We had 2 members in our group blown off. I talked to them. So what happened? Man, I'm taking a break and stuff. You know, this market's too tough. You know what that sign is? Whenever traders capitulate, it's a tradable bottom. Whenever traders capitulate, it's a tradable bottom. because the machines want you on your knees crying. I don't need to remind any of you on that. When you start to feel like crying, you want to be the most aggressive buying the market. In 2009, I saw fund managers in front of me, brokers in front of me crying because they thought that's it, it's over. I don't cry because what's there to cry? I mean, what am I gonna go beg out there? It was a terrible time for all of us. Even though we were short at times, it was still a very difficult time on Wall Street. When you see grown men cry, traders collapse, buy, 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 like Kramer says, okay? And I saw a couple of them this week in our group because they were too lopsided on one side or another. So that is a tradable bottom, both behavioral and technical. So let's go straight through here. And guys, this is tough talk. This is the reality of this business, okay? This is the reality of this business. Exactly. So technically, deep oversold. We are bouncing off some major technical levels here. One of the technical levels they bounced off, and I'm going to show you this, and it's very clear, is where we were during the Fed fake out was right here. Is it funny that we exactly bounced off that? You think some machines were programmed to buy the market on that? I showed this in my video cast from last week that there's a big possibility we would come and test this breakout level. Remember, this, ladies and gentlemen, is a breakout level right here. This was a failed breakout. This was a breakdown. So this is a major resistance level. And guess what we did? We broke out, we came and tested it, and then we took off. And then we came down and tested the same breakout level. Guess what? We held it. It also happens to be on the daily. This is a 4-hour chart. On the daily, it's a test of the 50-day moving average. So now we're going to basically go like this to the top of this channel and then maybe collapse again. I don't know. But it's not a coincidence that the machines decided to come and test exactly the same level that we broke out from back around the 19th of October, right there, multiple times. Now, if we fall again and we still hold this line here, which is let's say the 2010, 2016 level, that's going to be powerful. Generally speaking, a retest of the lows is a common occurrence. I'm warning all of you. It's a good thing, because if it can hold this, then the market's just going to go. Then the shorts are like, excuse my French, shit, this market is way too strong. They start panicking. What happens when shorts panic? Markets ramp up. They ramp up. So at that point, if we do a double test, a double bottom retest, then it becomes a 1, 2, 3, 4 quadruple bottom. We're going to really move higher. Okay? So let me move on to another chart. Okay, let's take a look at the SPYs. This is beautiful. It really is. I wish we were all just machines and we're like a V12 turbocharged engine. Just feed it a lot of premium gasoline. Okay. So no kidding. So basically, at this point, look what we did. Because if you have to study charts. The fact that you're listening to this is worth a lot of money in your pocket going forward. Believe me when I tell you, because nobody teaches like this. Nobody. I've been in a lot of sessions and stuff with other services years ago, and believe me, all they talk about is the same old garbage. Honestly, they do. So anyway, the bottom line is, look how symmetrical this is. One of the things I talked about from day one, and some of you have taken lessons with me quite a bit, is the fact of looking at the directional bias of the 50 and the 34-day moving average. Train your eyes to look at the directional bias. It's so easy to see. Yeah, maybe it's not that easy to operate when the markets are falling 300 points and you're stuck in a position and your whole head is like, oh my God, why the heck did I buy those options at 5 or a stock at 20 and now it's at 14 bucks? That's a different story. But let's look at this, what's going on here. Not only do we have a dragon bullish pattern, we already have established that fact. We came down and tested the big breakout line. I've mentioned a zillion times that we get a lot of the times we on a severe sell-off, we will test the downtrend breakout line. That's exactly what we did. I don't make this up. I drew this line 2 weeks ago. I drew this line from here. I mean, from here actually, because once this line point was established, I drew this downtrend line. So that's been since August. So we tested this. What else do you have to watch for? Go back to the simple basics of what I taught in the first session. Is 34 50-day moving average, Bollinger Bands, right there. It bounced right off the Bollinger. It's not magic. It's pure algorithmic high frequency trading stuff. We're trading off the same levels. 50-day moving average still pointing up. The crossover, which was big right here on the 26th of October, that's still intact. Right? That's still intact. These are still pointing up. All of the curves. Imagine this to be a wave. Imagine this to be a wave. Well, look what the wave is doing. Follow the wave, you know. Go surfing. Follow the wave. Right there. The wave is going higher. So we can very easily, in my opinion, there's so many ways to decipher this chart, okay? We're within a trading band. The trading band is 2113 on the SPYs, and the low end of the trading band is basically 200. That's it. That's it. Is it just going to go straight up here? I don't think so. But who do I know? Did I think that the market was going to go from here to here with that fast? No. But this time I'm committed to the fact that I'm not going to get just brushed aside just because you get little dips along the way. This I traded reasonably well. I could have done better. I wasn't bullish enough. I wasn't bullish enough. When I microanalyze things too much, remember, it's called analysis paralysis. When you're in battle, you don't think twice. You just do it. Well, this is a battle, so just do it. Within reason. So at this point, it's possible. Again, I've showed you the levels. 207, there's a small gap here that gets covered. This is the downtrend line. That downtrend line obviously is going to hit, is going to hit real fast. That's also where the gap is. There's a small gap here, right there. So let me bring another very simple point here. Observations from the chat room. Why guess so much when the charts are being laid out for all of you? And you should take a few minutes, like my good friend KG. He's going to hear that. He's going to give me a growl. He's a great trader. He's a futures trader. But as in a market forecaster, he doesn't even come close to me. And KG, I hope you're listening to this, okay? He never looks at my charts. He never studies or understands what I'm looking at and this and that. When it comes to forecasting and prediction, I blow him away. Fast, quick trading on certain intraday routines, he's the best. But the big money is made on the swing trades, ladies and gentlemen, not on the intraday trades. The intraday trades can make you seriously good money too when you have 300-point swings and you manage to catch it from the bottom or intraday swing down on the short side. But when it comes to predictive forecasting, I have repeatedly shown, for years, that, especially since my service started last year, that I can do it. And predictive forecasting is the toughest job in the world, no bar none. So, which brings me to the point here. I don't mind people talking about, this and that. But I hear sometimes people who are actually smart, traders in the room, who just insane. They're talking stupid stuff. Like, oh, wow, well, let's see, maybe it gets there, hope it gets there. I mean, great technical operative words. why not look at the charts and say, hey, there's a gap. It looks like it's going to go there. A lot of you do, mind you. I'm not complaining about anything, but I'm just saying I hear a lot of that. Like, stop the guessing. Look at the charts. Working day, literally 24/7 for all you guys to put these charts out so you can study them and say, okay, this is tactically where we can go. So make use of what's in front of you. All right, please. Now, on the daily basis, on the SPYs, we are turning. We haven't fully turned yet. So like I said, don't be surprised if we pull a little U-turn and come down here, and then make a move here. Just showing you the alternative scenario. All right. If you get a big pop up, what do? My good friend Savvy knows. You sell. You sell gap ups, or you leave a little bit of a runner in there. Savvy's fantastic at doing that stuff. So the point is that, but if you gap down, you don't panic. You look to see what's operating around there. You don't panic and sell here and see the market make a U-turn. Happens all the time. As long as this is turning. If this is not turning and continues to remain down, obviously that's a different story. That means something is really rotten, right? Okay. Now let's take a look at one of my, where I think a significant amount of money can be made, and money that can be made up from whatever was lost, or lost on paper, I should say, on last week, or the latter part of last week. And that is the, drum roll, that is the Russell 2000. There are now guys on the futures pits who are talking about the outperformance of the Russell against the S&P 500, which I mentioned last week, right? And now they're talking about it. I actually put that article out there. These are serious futures traders who are basically saying outperformance of the Russell over the S&P 500. Lo and behold, why? Because the most oversold sector in the market is energy. Energy generally, seasonally speaking, and now that ISIS is getting bombed out of oblivion, and they, believe me, they will this time, okay, there will be supply lines which are going to get bombed. Refineries blown out. There will be a mini oil / political shock on the oil side. That's going to cause a little bit of a shortage on the supply side, or at least psychological shortage. There's enough oil in the reservoirs, in the strategic reserves. So that's not a problem. But that's going to book oil move higher. Russell 2000 not just oil dependent, but it'll do it. The other thing is we might start to get a series of economic numbers as we overlook the past 2 or 3, which show that the U.S. economy is still going. So sorry about that. I was reading a text. So bottom line is, if you look at the Russell 2000, this is in the old days I used to call it the drooping willow pattern. And I am no botanical expert either, okay? But it just looked like that. This one is the dragon bullish formation is still very much in place. We have a consolidation move down here. That hurt on my Russell calls, trust me, okay? And because I sold a bunch and I still held a bunch, and then I bought today. So give it a couple of days, let the trade work. You got a nice reversal candle off here. I would say that we are in good, we have a pretty good shot at getting up to 1200. You get a 50-point move or a 44-point move on the Russell 2000s. I don't need to tell you what the calls do, okay? Or the IWM calls if you'd like. All right, so that is that is a powerful that is definitively a outsized move, bigger than the S&P 500. And in order for this pattern to get completed, the Russell 2000 needs to go to 1224. Now keep in mind the Russell 2000 is US small cap growth, so it's very dependent on any type of economic data that comes out during the day. It's dependent on what interest rates are doing. It is not as dependent on the dollar, but it is somewhat correlated with the dollar in the sense that there are a lot of oil companies and energy companies hidden within the Russell 2000 and the Wilshire 1000 and stuff like that, the smaller cap indices, and it's and that's why it gets jostled around. If biotechs fall for a certain day, let's say the whole index falls pretty hard, then the Russell gets hit. But at this point, this is what I'm seeing. You get a nice solid base here, this range, which is 1136 to 1156. Okay, and once it breaks out of this base, it starts trading in this range, which is 1160 to 1200. It's really as simple as that. There's nothing to it, and that's a pretty significant number. We at least on these stochastics, we're not fully oversold yet, so we'll see. We'll see what happens. But this pattern is certainly something that you want to be involved in. Looking at the IWM, this is a very interesting chart here. Same chart. I have a channel drawn here. This was the downtrend channel that the Russell was falling in. Then you had the August crash. Then you had the September 29th crash, in which case it actually went lower than the August crash. No other indices did that, just so you know. Okay, August was the definitive low for the SPY and the QQQ. But for the Russell 2000, September 29 was a lower low. Big move from here. I did call that one. And it went up fast and furious. In between, obviously, some nasty red days. I'm sure there were a lot of Wednesdays there. So then it gets up here, gets overbought, hits that Fed fake out day, which was right here, 917. And then we come down. And comes down hard. Then what does it do? It touches the Bollinger Band. It tests the downtrend line. Stuff that I talked about on the first day. That's what patterns do. And it does that, and now it's moving. Want to make money? It's going to move up here. There's a nice gap here at around 117, 116. I've shown all this on my other charts. And there's still room to move. Once it does that, once it hits the gap, there's always some turbulence. Hopefully it doesn't fall all the way apart down here, in which case it really wouldn't feel good. But even if it does fall here and it holds the 112 level or 113 level, it can still bounce. It would still be like this is the head, this is the left shoulder. Let's say you put it that way. So even if it hits the right shoulder and comes down, it can still manage to move up here. Just so you know that. But in the meantime, short term, this gap gets filled around 117. So you still have 2 points you can play on that, which roughly brings us on the Russell 2000 to, because IWM is the ETF for the Russell 2000, right? So the Russell 2000 goes to somewhere between 1170 and 1180. That's pretty much the gap fill on that side. Let me show you something I was watching. I mean, the UVXY and the VIX, these are derivatives. I mean, the UVXY, I mean, they just hammered it. Is it a coincidence that it hit the downtrend line again and went down? That it filled this gap here that I had drawn last week, that it fell? The little bit of the UVXY that I bought and still had from Friday was sold pretty much at this level, right at that gap fill. Remember, the pattern still shows it can go to 42. It could have gone to 42 today. If the market hadn't turned, this would have gone to 42 and we would be down another 200 points. At that point, nobody would be in the chat room. They'd be sleeping in the Salvation Army place. So the bottom line is the robots came in, started selling hard, markets turned, and that's why this came down like that. Now at this point, there's a small gap here. I don't want to get into this too much, but which is a 2863. It's possible that it hits that gap and tries to bounce. Who knows? We'll see. And that's a possibility, just so you know. The chances of it going back to 24 are still there, but for that to happen, the market has to go back to 2120 or the Dow has to go up to 18,000. Just so you know that. When Dow goes to 18,000, then the UVXY will be down to 24, which in my opinion will be another buying opportunity. Now, Dow Jones Industrial Average. Not much to say here. This is a megaphone pattern. Top of the megaphone is around 17,785. So we're looking at another 300 points. If we do blow out over that, then you're looking at 18,000. Upper Bollinger, also this uptrend line from here, from the August lows. I'm sorry, September 2014 lows. Wow, right there. I drew this line, and that also coincides with the upper Bollinger. So the most you will get out of a major run in the market is 18,000, 18,100. So if you want to, We engaged the 34 very nicely. We bounced off that with the bullish engulfing. That's very positive. Upwardly rising 50-day moving average is still intact. We are oversold. Maybe not as oversold that I'd like, but we are oversold. Let me show you one other chart here, just so you guys stay on track and not, not run to BJ's or Walmart to buy diapers, okay, on rough days. Where is it? The 533. Very important chart, very important. Keeps you in the game in a big way. This turn is significant. Significant. I don't know if it's fully confirmed. I don't like the word confirmation anyway, you all know that. But if this turn is similar to this, then boy, we are in for a phenomenal run in the market. However, a couple of things you have to watch on the 533, and I show this time to time. Number one, this gets really overbought up 90. That means you sell. That means you sell. That's it. Doesn't matter. I don't care whether Savvy thinks Netflix is going to $900 from here. You sell. You basically stay up in the 90s. You sell. So the bottom line is that that's real overbought condition. It can stay overbought like it did here, but that's okay. In the meantime, it will correct. Went up here, it did correct, if you notice. Okay, now if this turn is correct and if this works out, and it's never that simple, like I said, big money can never be made just because it's simple, then everybody could do it. So if this turn is correct and we are going to bounce, have a sharp stochastic bounce, these are stochastic lines, look at that. Okay, full stows, directional D. So if this is going to bounce like this, that means this will go up to 21.25, which also happens to be the upper Bollinger. Because what I do with this chart is I put these, this wave is basically the Bollinger Bands. The Bollinger Band simply allows me to see a context of where the market is trading in. You want to study more analytical stuff on the Bollinger Bands, type in Bollinger Bands and go, learn about it. So if the market is going to trade within the Bollinger Bands, then it's trading with roughly within 100 points. 100 S&P points, 2025, 2125. 100 S&P points is roughly 700 to 800 Dow points. So 100 SPX points is roughly about 700 to 800 Dow points. That's what we're trading in right now. We went down to 17,000 almost, right? I'm going to see that in a second. What was the low for the day today? The low for the day was 17,210. Okay, 17,210, add 700 to 800 points. Somebody do the math, that's 18,000. So 18,000 magnet is back in the picture again. And that means that the S&P goes to 2125. You want to make 75 points in the S&P 500 without intraday trading like a wild mouse? Well, guess what? You can do it, I think. It won't be a straight line. Maybe it zigzags around, but 75 points in the S&P 500, you will feel like you are a monster trader. You just want to go out there and run your own service. 75 points on the S&P 500. Let's say it takes 2 weeks. Do you know that 30 points, 10 points in the S&P 500 generates significant profits? And 75 points? Well, see you later, right? So you want to do it? Go buy a far out call. Go buy one for November 4th, 2021 25s, and leave it there. Test it. Test it. That's how you learn. So this is good. If this turn is valid and it confirms itself over the next, I'm sure you guys understand what follow-through days are. Follow-through days are roughly the third day or fourth day. I can't remember if it's the third or fourth day after a major reversal like we had today, that the market basically has a follow-through day. That means it follows through in the same primary trend of a move up or a move down. So we could get jostled around on Wednesday. I still think we go up tomorrow and then Wednesday we fall. I said this earlier on today. So if we corrected Wednesday and Thursday we ramp again, that's the fourth day, correct? That's the fourth day. Do the day count. Fourth day. So on the fourth day, the sun rises hard. That's a follow-through day. Investors Business Daily tracks it big time. I haven't seen IBD in a while now, and that that is considered very powerful. You get a follow through day, you're going to hit 21.25 real fast. In the meantime, you notice how fast we're moving after being oversold. So that means we're going to get overbought pretty quickly. Just because you get overbought doesn't mean it's going to get pulled back. It simply means that at that point, you don't want to be chasing things too much. That's the 533 directional chart, which has always helped in, in the meantime, the histograms have to start getting smaller and go positive, similar to what happened here. Get it? Similar to what happened here, except this was multiple days. We don't want this to happen. That was a little bit too much. So point is, if this starts to get smaller and then goes in the positive territory, by that time it gets overbought. Let's say it goes up to about 10, couple of extra green bars, and then you are all the way up to 21.25, which is pretty much at the highs of the market. But next high we hit the market, in my opinion, we're breaking out. That's my opinion. Because every time you punch a wall or a floor, it gets weaker. So if you're punching a resistance level repeatedly, then that's going to get weaker and the market's going to break out. So I'm going to leave myself open for, let me just show you the futures chart a little bit, real time. And let me stop myself and just ask a simple question. I'm giving you some serious info, guys, that you guys can act on and do what you need to do. Okay? Work with this. Is this making sense?
For me, absolutely.
Just somebody be truthful and said, no, it doesn't make any sense. And I'll be more than happy to explain it a little while, and then I'm going to tell you to go take a nice walk and get some fresh air. Because I don't know how much more I can explain for this not to make sense. These are years of experience talked about in a simple 1.5 hour session. Believe me when I tell you. It is not the charts I give you, because they are actionable, both on the upside and downside. It's what you guys do with it. What you guys do with it. And that's all I can tell you. Now, looking at the ultimate SPY chart, which is this one, which I love, look what it's doing. Not magic, huh? Back in the channel, and it happened all in one day. Now we're getting overbought now on the 1 hour chart. So if we open up big tomorrow, don't chase it, please. Because at this point, the most we're going to go up to is about 207, as you can see here, 207, which is the confluence of the 50-day moving average, back testing the 50-day moving average, and the Bollinger Bands right here. By that time, you see what's going on. Now, I'm going to show you the oil. Called it. This is the daily chart on oil. Pretty symmetrical. See these marching soldiers all the way down the canyon? That's robotic selling. This is not human selling. Okay, that's Mark Bader right there. There's Shawnee. Savvy somewhere in here, running back and forth. Trina somewhere there. Guys, this is robotic selling, okay? Systematic margin, institutional margin sell-offs, visualized in the form of red, fat candles and lots of screams in the room. That's all of you guys, including me, feeling like crap because anything that I bought on Friday kept on slipping. Not today, but Friday. Buy when it's blood red. Technical blood red, not emotional blood red, and sell when it's green. Very easy to say. It's actually pretty easy. But the hardest thing is getting your mind to think like that. So the point is, this is a major reversal candle right here. Don't be surprised. Oil slippery business. Yeah, stochastic is oversold. Looks like it definitely wants to go overbought. But what does oil do? It slips up a little bit more. Boom, it can slip again. It can lose 60 cents. All of a sudden, those USOs, which are at 24 cents, can go down to 16 cents. Doesn't change anything. The only thing that changes is the price on the screen allows you the chance to buy because you still have till Friday. And I think by Friday, we get to 44. If not, test the downtrend line at 47, which would be humongous. Which would make my friend Tats Boom cry in joy, as he did last time when he listened to me and bought the well, he was buying it himself, and then he validated by my charts. He bought a ton of the USOs. So again, the point is that this is a powerful reversal, and if it follows through, the first step is right there, 44. I've shown this chart. Use it. There's some turbulence at 44. And then if it breaks out over that, then you're looking at basically testing the downtrend line over the 50 and the 34. It's still a crappy looking chart, but this is turning out to be a bullish, dragon bullish. Longer term, going into the end of the year, oil's going to be higher. No question about it. And then a couple of bombs dropping over the oil fields in Raqqa and those places where the ISIS capital is. Well, guess what? You will see oil spike like nobody's business, and you will cry to yourself if you don't own some of these lottos. You'll literally cry, guaranteed. And do, feel free to post a picture of you crying. So this is a dragon bullish. It could slip. That's the funny part about technicals. 38 is still in the cards, believe it or not. So let's say example, it pushes 38, finishes the whole pattern almost, and then moves from here. I don't want it to go to 38, to be honest with you, but just giving you a scenario. Otherwise, it holds here and then pushes up from here. Whichever the case, the pattern does not get completed till 50. Oil will go to 50. Oil is basically trading in a 10-point band, and that 10 point is worth a lot of money. So if people who are swinging this trade, then you're looking at about 44, 48, and then 50. But with a lot of volatility. But it really did get oversold. So now I'm going to take a question or two, and then we're going to wrap this up. Woo, it's 9:35. Any quick questions?
If nobody else, I do.
Go ahead, Shawnee.
Your moving averages. I noticed today you mentioned something about using a 24-day moving average.
Nope.
I also noticed. Okay. I also noticed that you use 1 and 2 hour and daily time frames, but the moving averages, you're consistent in using the same moving averages for all your charts, no matter what time frame?
At this overall, I found them to be very helpful. I used the 5. The 20 is a useful one to use, to be honest with you. That is a good one. I've used it before. The 20 is a good one. The blue line here, this highlighted blue line, is the 5-day moving average. That works really well to track short-term movements. The 50 and the 34 allow me to stay on track. The 20-day moving average I don't use much, primarily because my chart starts to get a little too crowded. But generally speaking, yes, I'm using the same parameters on different time frames, and they seem to be working really well. For example, this is the 1 hour, as you correctly pointed out, right? So I'm using the 50. This blue line, by the way, is just simply the mid-Bollinger. This line here is the this line here is your 5-day moving average, which is a great barometer of short-term movements. It's curled up nicely, as you can see, right there, right there.
Yes.
There you go. It's highlighted now. That's powerful. So it looks like it wants to wave, wants to go up towards the upper end of the Bollinger. Now let's say I look at the daily on the same parameters. So on the daily, I find it to be pretty useful too. That the market bounced off exactly on the SPYs. I'll actually show it on this. Make this bigger.
On your charts, I've noticed that when you start teaching more about the Bollingers and driving in the highway,
Yeah.
I've been able to follow your charts much better, and I'm starting to take educated guesses as to where the market's going, and I'm starting to surprise myself.
There you go. What you have said is the truth, because the more you look at these things that I have been looking at for a whole bunch of years, and more so in the last 2-3 years, and more so since I started my service last year, because now I'm forced to look at it because I have to present it to other people. Before, the biggest audience I had was just myself, right? So now it's a different story. Now I got to show it to all of you and actually make sense out of it. And honestly, the more you see it, when I look at this talks to me. This is talking to me hard. It's saying, hey, we held all these lines here. This Bollinger, this is telling me a story that this market wants to go higher at this point. When this turned, And I don't follow this that closely. I mean, I'm talking about my pivot charts and everything that I follow. When they turn, see you later story. And yes, you're absolutely correct. The more you start to visualize these things, they won't remain your strangers. They will become your friends. And that's what I try to get at. So I'm going to show you a chart of the live E-minis. And that's a great point that you made, Shani. Okay? And I'm glad that it's getting, like they say, people are starting to get it. It takes time. It takes a little bit of time. But the more violent, but just remember one thing. The more violent the markets are, the faster you learn. Just remember that. If markets were plain vanilla, you would learn nothing. Nothing. The more violent the markets are, the more turbulent they are. They're not supposed to make you feel good, but you will learn. They are the best teachers ever. You look back at yourself as a trader a couple of years down the road, you'll be like, whoa, seen it all. Why do you think half the time I don't get scared? Like, I mean, I do get scared sometimes, but I never get scared. Because what's there to get scared? We had a 1,000-point drop in the market. It hit an exact level and we bounced. I mean, the more situations you go through, you become a veteran of the wars, right? So that's what you become. So in effect, the more violent and volatile the markets are, the better off you are. But just have to manage it correctly, because you're a better trader you will be 6 months down the road, a year down the road. Softness doesn't make you a great trader. Bitterness and really the volatile reality makes you a better trader. So saying all this, look at this. It's so clean. It's almost geometric. It is geometric. You got look where we bounced off from. Look at this red line. This is the 50-day moving average. 50-day moving average. We actually went below that during the day. I mean, this is an E-mini. So yes, we went to 1998. 1998 we went to this morning. At what time? I'll tell you what time. Hold on. We went to I forget the time, but it was before the market, okay? Right here. We went there. And look at this bullish engulfing. So at this point, we're going to find some major resistance at around 2067. Am I clear on that? The consolidation channel coincides around 2064 and the mid-Bollingers at 2069. So let's call it 2065. We're going to see some major resistance. However, pattern symmetry dictates, and I'm going to make this bigger. Pattern symmetry dictates that we are most probably going to get up to about 2086. Remember, momentum begets momentum. A body in motion remains in motion, right? So if that's the case and this market's speeding up and the shorts are starting to get really scared, or some of them are, and I'm sure there are people who shorted the market hard today, for all I know, then you're looking at an overshoot to 2085. So the most we'll get to is somewhere between 2080 to 2085, and the least we'll get to is around 2067, which is roughly another 90 points from here on the Dow, short term. That's called predictive analysis. Just by looking at the chart, I can give you where the Dow will be. If everything breaks loose and something horrific and a black swan event like Paris happens again, then it looks like we will lose 1998. Then we'll have to obviously consider the next stop, which is around, which really is around much lower. At that point, we're looking at 1930, real fast. However, looking at the internals here, showing like the market wants to move higher. So, ladies and gentlemen, that's it. So what I got at is very simple. You know what I'm talking about. Apply what you see, what you feel. Actually, don't apply what you feel, because your feelings don't matter, crap. Seriously, don't apply what you feel. So apply what the technicals are showing you, what you understand from the technical stuff that I've shown you, and move on. Because if you don't act in these type of markets, and I will tell you this, and it's a fact, that at the most critical times in the market, junctures in the market, you have to be the most aggressive. I am telling you that right now. If you want to be conservative and really soft and scared and sitting there on the side and doing whatever, counting, doing abacus, all right? I'm telling you right now, you will miss every single move. This market is a market built on speed. I don't mean the drug, I mean speed. All right? Velocity, moves, because the machines are very much in control. So when you look at a chart like that, it's not like, oh my God, what is this? I don't see it. He's drawn too many lines on it. You better understand what I'm trying to show. You better understand what I'm trying to show, and that's why I'm taking so much time to teach you guys. This is a
Can I say one more thing?
clean cut chart. Yeah, go ahead.
I really wish others would ask you more questions in case they're thinking of something I'm not thinking of to help better me and
I don't know.
perhaps better.
I mean, if does anyone else have a question? I mean, I can be their mommy and daddies. Does anyone else have any questions? Instead of saying next, if I hear the word next time again, I'm just kidding. What do you call? Does anyone, seriously, does anyone have any valid questions? Or did a lot of the stuff, or maybe a lot of the stuff I talked about, Shani, made a lot of sense. So maybe they're comfortable with understanding what I'm saying. Now it's for all of you to apply it. Apply it. When you look at that chart going out on the Twitter feed, it's not just a colorful picture. It's there to hopefully make you money. Not just for you to look at and just kind of like, okay. And remember what I said. You can't have your P&L green every day. Have your P&L red 1 or 2 days, you get monster green P&Ls, profit and loss columns on days like today. So please get used to that idea. And I mean it for every one of you who's listening and many others who will listen to the recording. You can't get green P&Ls every day. That's stupid.
You also asked us to bring up our Twitter account for a reason?
I know I didn't have time, but basically one of the sessions, what I'm going to do is I'm going through every single chart that I posted during the day. Okay. I mean, this chart, for example, that I posted during the day, bear with me 1 second. We're on Apple. I mean, look, I don't even trade Apple that much, but this was unbelievably convincing. This is a beautiful chart. Perfect symmetry. What's going on? And those Apple calls exploded. So off the lows, this is a bullet engulfing. Hopefully it's not another bearish engulfing. Now the red bar comes here. That's a different story. At this point, what it looks like, Apple wants to, and this is a daily, so it's a little bit longer term. It's a daily? Yeah, I believe it's a daily. So bottom line is this one looking like it's eyeing the gap fill. So charts like this, you gotta you just got to play on it. So that's why I'm saying, like, the Twitter feed is extremely important because it's showing you a lot of stuff that's going on. Look at Tesla, showing this. Look at the VIX. I'm showing you the backside of what's going on. This is a great one. This is a beautiful one. Look how it bounced off the downtrend line. Yes, this big green thinks that's a very bullish statement. I agree with that. Okay, I made a bullish statement. So what? There's a gap here, so it's going to hit that gap. But it's for you to look at this, match it with this, and say, okay, is it a risk reward worth buying? My risk is down here to the Bollinger. My reward is up here to the Bollinger. Gap fill, possible pattern symmetry completion all the way up here at 118.95, call it 119. Is it worth the trade? That's how you have to think. Not like, oh my God, I just bought something and it's down like 50 cents. So no one else has any questions, correct? Everyone good? Everyone good? Good. I hope it made a lot of sense. And every time, look, I wanna impart as much as I can, but I laid it down today, guys. Okay, ladies and gentlemen, because honestly, you guys gotta wake up. Many of you have to wake up. But I know the ones who are here already woken up because you guys are actually here spending time. The others, that's it. Gotta play it. Mental. Fix your head. You do great. And confidence breeds confidence. Don't worry about what happened on Friday and Thursday. If you got caught in some positions, so be it. Now is your chance to double and triple those red P&Ls that you saw on Friday. But you'll only have a short window to do it. A very small window to do it. Act on it. And that's all I have to say. All right. So have a great evening. We'll see you guys tomorrow. And like I said, in this type of market, it's not one step at a time. It's 2 steps at a time. And try to go backwards half a step. Don't always wait for me to tell you, oh, get out of this position, this and that. You figure out your thing. If your pain threshold is getting a little high, you don't think that's going to jump up. Okay? There's certain stocks that don't bounce. Certain stocks that just don't bounce. Like GoPro, I don't even look at it. That's what a trader does. He moves on. So that's what I'm saying. And certain stocks are just volatile, like the Netflixes and the Teslas and the Amazon. Amazon, man, I mean, I should have got it today because I sold it pretty much at the highest the other day. I mean, Amazon, what was the reversal in that today? Lord, the reversal was 25 points. I rest my case. All right, guys, ladies and gentlemen, thank you. And like I said, this is a difficult yet a very structured market. The more you understand it, the better you'll do. Things won't change in one day, but it'll certainly change a lot sooner than what you think. I'm talking about your own trading health. All right, that's it. Gotta go. Thank you for listening. Stay clueless.
Thank you.
Bye. Sure.